Hello, and welcome to Virginia International University's MBA 605 online auditing course. During this session, we're going to talk about the audit of the sales and collection cycle, which will include discussion around test of controls and substantive test of transactions related to this business cycle. We'll identify the accounts and classes of transactions that we look at in the sales and collection cycle audit. We'll describe the business functions in terms of the documents and records that are generated as a result of this cycle or function. We'll also understand the internal controls, how we design and perform tests of these controls, and then the substantive test of transactions for sales. We'll also understand how to apply the methodology for controls over sales transactions to controls over sales returns and allowances. We'll understand internal control and design and perform tests of controls and substantive tests of transactions for cash receipts. And then we'll apply this methodology for controls over the sales and collection cycle to write-offs of uncollectible accounts receivable. The overall objective in the audit of the sales and collection cycle is to evaluate whether the account balances affected by the cycle are fairly presented in accordance with accounting standards. And here we see an illustration of the multiple different general ledger accounts that are involved in the sales and collection cycle. They deal with sales, which is an income statement account, to accounts receivable, which is a balance sheet statement account, the allowance for uncollectible accounts, and again, other accounts included the cash account, cash discounts taken, sales and returns and allowances, and bad debt expense. And we'll see how all of these are interrelated, and then how we go about performing an audit of the function that includes all of these. The sales and collection cycle involves the decisions and processes necessary for the transfer of the ownership of goods and services to customers after they are made available for sale. Before auditors can assess control risk and design tests of controls and substantive tests of transactions, they need to understand the business functions and documents and records in a business. And here we see for the a sales transaction, we see that the accounts generally involved are the sales account and accounts receivable. The business functions that are usually involved in these transactions are processing of customer orders, granting credits, review of credit worthiness, shipping of goods, and then billing of customers and recording sales. These functions in turn generate documents such as a customer order form, a sales order form, a shipping document, a sales invoice, the accounts receivable master file, which supports the accounts receivable trial balance, and then monthly statements to the client. We can see the same sort of scenario with respect to cash receipts transactions, where the accounts involved are again cash and accounts receivable. The business function is really the processing and recording of cash receipts, and the documents that are generated as a result of this function are remittance advices, cash receipts transaction files, cash receipts journal or listings, and so there are various different documents that are generated through the cash receipts transaction that the auditor will be working with in testing controls, and then later in substantive testing of that process. When we look at the sales returns and allowances transactions, we see we're dealing with accounts such as the sales return and allowances accounts and accounts receivable. The business functions end up being the processing and recording of sales returns and allowances, and then some of the documents that are generated as a result of that function are documents such as the credit memo and the sales returns and allowances journal. For the write-off of uncollectible accounts transactions, we deal with accounts receivable and the allowance for uncollectible accounts. The business function is really the writing off of uncollectible accounts receivable, which means reviewing accounts receivable and determining which ones we are going to collect on and which ones we believe the customers will default on. And then the documents that are generated as a result of this is the uncollectible account authorization form, which essentially provides the approval or authority to write an accounts receivable off, and then the general journal, which evidences that write-off. Under the bad debt expense transaction, we look at accounts including bad debt expense and allowance for uncollectible accounts. We have the function is providing for bad debts, and then generally the document out of that is our general journal, which evidences how we account for our bad debt expense. So weak practices in credit approval often result in excessive bad debts and accounts receivable that may become uncollectible. So it is important for all companies to have some sort of vetting of potential customers so that they can make a determination. So very similar to the other business cycles and functions that we looked at, the methodology for designing controls and substantive tests is to understand the internal control around sales, to assess the planned control risk around sales, and then using that to determine the extent of testing of these controls. And then based on the extent of testing that we determine, we'll design our test of controls and then the substantive test of transactions for sales to meet transaction-related audit objectives. Auditors study the client's flowcharts, make inquiries of the client using an internal control questionnaire, and perform walkthrough tests of sales to understand the internal controls around the sales function and recording. This is very similar to the other business functions that we talked about and how the auditor gets to an understanding of the internal controls around that function. And so the transaction-related audit objectives provide this framework for assessing planned control risk. Key internal controls and deficiency for sales will differ for every audit because every client has different internal controls. The auditor then associates the controls and deficiencies for each objective. Then the auditor assesses control risk for each objective. This step affects the auditor's decision about controls and substantive tests. Proper segregation of duties prevents various types of misstatements due to both errors and fraud. Proper authorization has 3 key points. Credit must be properly authorized before a sale takes place. Goods should be shipped only after proper authorization, and prices including basic terms, freight, and discounts must be authorized. Adequate record-keeping procedures must exist before most of the transaction-related audit objectives can be met. Pre-numbering is meant to prevent both the failure to bill or record sales and the occurrence of duplicate billings and recordings. Sending monthly statements is a useful control because it encourages customers to respond if the balance is incorrectly stated. And finally, computer programs or independent personnel should check that the processing and recording of sales transactions fulfill each of the 6 transaction-related audit objectives. In audits of public companies, the auditors must perform extensive tests of key controls and evaluate the impact of deficiencies on the auditor's report on internal controls over financial reporting. The extent of testing of controls in audits of non-public companies depends on the effectiveness of the controls and the extent to which the auditor believes they can be relied on to reduce control risk. And so here we see some of the COSO identified revenue misstatement techniques. So what do companies do? What are some of the fraudulent techniques that companies do in order to inflate revenue, which would include things like sham sales, that's recording sales that really didn't happen, or improper sales cutoffs, so recording sales that happened in the next period in the current period to inflate sales, consignment sales, or bill and hold. As you can see, each of these has their own set of problems, and the auditor should be aware of what these mean, so that when they go into test sales, which are related to revenue recognition, they're able to recognize where some of these may exist and to respond accordingly. So this is the summary of the methodology for sales. Well, when we're auditing sales. So we identify the key transaction-related audit objectives, we determine existing controls, we test these controls to verify effectiveness, we evaluate any control deficiencies, and then we determine the extent of substantive test of transactions. So if we can rely on controls in some areas, we don't have to test as much. If we don't rely on controls, our samples have to be larger so that we test more. And so if audit tests for controls are unsatisfactory, it is necessary to do additional substantive testing of sales, sales returns and allowances, write-offs of uncollectible accounts, and processing cash receipts. So there again, if we find that internal controls are weak and we cannot rely that they are going to catch errors or omissions or fraud, then we have to increase the amount of documentation that we test as a result of our substantive testing. And so that's the presentation we have here on the audit test for the sales and collection cycle. Please go back and read the chapter. This discussion was meant to just pull out the key highlighted areas of the chapter, but it shouldn't substitute for a thorough read. And then please move into the practical area for work. Thanks very much.